Imagine making mortgage payments for the rest of your life. You buy a house in your 30s and you're still paying it off in your 70s. That's not a joke. That is exactly what could happen if Trump's 50-year mortgage proposal actually becomes reality. Over the last week, President Trump floated the idea of a 50-year mortgage as a way to, quote-unquote, help Americans afford homes by lowering monthly payments. Sounds nice, right? Lower payments, more people can buy, housing problem solved. Yeah, not so fast. Because when you actually run the numbers, a 50-year mortgage barely lowers the monthly payments, but it explodes the total interest you pay, and it actually keeps you in debt for decades longer. And if anything goes wrong in the housing market, you're the one left holding the bag. So in today's video, we're going to break this down like adults. What Trump actually proposed, how 30-year mortgages really work, the real math on a contradictory 50-year mortgage, why it could be a disaster for buyers and the housing market, and what would actually make homes more affordable. Now, sit back and relax. Subscribe while we take the break, and stay tuned while we go over all these details, and more importantly, you will know how to protect yourself, because by the end of this video, you will know more about mortgages than most people signing them. Welcome back to the Next Level Lifers, where we take the next steps needed to go towards our financial freedom and success. Now, let's start with what was actually said and not what went viral. Trump shared the idea of a 50-year mortgage as the next evolution after the 30-year mortgage. He even posted an image comparing himself to President Roosevelt, who helped standardize the 30-year mortgage. And then it got more real, because one of the country's big home builders jumped in and basically said, thanks to President Trump, we are working on a 50-year mortgage, a complete game changer. Now, before we panic or celebrate, let us be clear. This is not signed into law as yet. It is not yet an official new mortgage program either. It is an idea, a proposal that builders and politicians are very excited to talk about. But here is the problem. Most people hear 50-year mortgage and they think, sweet, lower monthly payments, I can finally afford a house. And that is exactly how dangerous products get sold. So before we decide if this is a blessing or a disaster, we need to rewind for a second and understand how the 30-year mortgage worked and how it became the standard in the first place. Now, how the 30-year mortgage really works and how it is not perfect either. Let us rewind the clock. The 30-year fixed mortgage was not handed down from heaven. It was created in the mid-1900s to help families buy homes after World War II. The idea was simple. Give people a long time to pay, keep their payments predictable, and let them slowly build their equity over time. And honestly, it worked pretty well. Today, around 90% of US home buyers pick some version of a 30-year mortgage. It is seen as the safe option. Fixed payment, long-term horizon, relatively easy to qualify for. But here's the part that nobody thinks about. With a 30-year mortgage, your payments are front-loaded with interest. That means in the first few years, most of your payments are interest and not principal. You are actually renting money from the bank and barely touching the loan balance. Only later on, like say maybe year 15 or 20, do your payments start going heavily towards the principal and real equity. Now picture this. You buy a home with a 30-year mortgage. You stay for 10 to 12 years, which is actually pretty average in the US. You move, you sell, or you get a new mortgage somewhere else. What did you just do? You spent a decade paying mostly interest, and then you restart the clock with a new 30-year mortgage later on. So even the normal quote-unquote 30-year mortgage, it has a hidden downside. If you move or refinance often, you are constantly stuck in the interest-heavy part of the loan. Now, if that is how slow equity builds over 30 years, imagine stretching that to 50. And this is where things go off the rail. Let's look at the harsh math of a 50-year mortgage. Everyone understands that going from a 15 to a 30-year mortgage, it made a big difference in terms of the monthly payments. That is why people do it. But let's use a simplest example. Take a $500,000 house. You put 20% down and you are charged a 6% interest. On a 30-year mortgage, your payment on just the principal is around $2,400 a month. To qualify, you're going to need around an income of $7,500 per month, roughly 3 times the monthly payment amount. Now, on a 15-year mortgage, the payment jumps to around $3,300 a month. Now, the bank might want you to be closer to $10,000 per month in order for you to qualify, and that is in terms of your income. So what do most people do? They pick the 30-year mortgage. They choose the lower monthly payment. It is easier to qualify for, and you get more house in terms of square footage. Cool, logical, right? Now, here's where people go wrong. They think that if they go from the 15 to the 30-year mortgage and it helped them by that gap, then the 30 to 50-year must help even more, right? Absolutely wrong, because the benefit curve flattens. Going from 15 to 30 years massively lowers the payment. Going from 30 to 50 years, though, on the other hand, it barely moves the needle. Let's break it down with a different example. Say you borrow $400,000, which is roughly where the average price is now in the United States, and you are at 6.5% in terms of interest rate. On a 30-year mortgage, your monthly payment is going to be around $2,500. Total interest over 30 years is around $510,000. Now stretch that to a 50-year loan at the same 6.5% to keep things simple. And just to be generous, your monthly payment drops to around $2,300. The total interest, though, that jumps to around $980,000. So you save like $200 to $250 per month, but you actually pay hundreds of thousands more over the lifetime. Look at it, $510,000 in interest for a 30-year mortgage compared to $980,000 at the 50-year. And even if you try to sell the house after that period, there's absolutely no guarantee that the house you bought for $400,000 could be sold for $980,000. And here's the kicker as well. This is the rosy version. In reality, longer loans are riskier for the bank, so they usually come with a higher interest rate, not the same one. So that $980,000 that we previously looked at, that has now skyrocketed to well over $1 million based on the risk assessment. The next sad part is, with a 50-year mortgage, more than likely homeowners are going to be passing on those monthly payments to their kids and to their grandchildren. So the albatross actually passes on from generation to generation when the equity is taking longer and longer to build. Now let's look at the flip side. Do the banks and mortgagors really want your 50-year loan? If the 50-year mortgage is such a brilliant idea, why was this not introduced previously? Why haven't the banks actually introduced it many years ago? Could it be that they are not in favor of it because, guess what? It might put them at more risk? Let's dive deeper. Most people do not keep their 30-year loan for 30 years. They move, sell, or refinance after, say, 7 to 12 years. Mortgages are usually bundled into mortgage-backed securities. Those are tied closer to the 10-year treasury yield because that is roughly how long loans actually stick around. Investors actually like that because it is predictable. They know roughly how long they will get paid, what types of return they will earn, and how the risk actually looks. A 50-year mortgage, though, that blows up that model. Think about it. If interest rates go down, investors will lose that long stream of income they thought that they were going to be getting. If interest rates go up, investors are stuck for decades holding a low-yield loan. From investors' point of view, that is much more interest rate risk. And guess what happens when risk goes up? Either the rate goes up or the product becomes niche, expensive, and harder to get. That is another issue, because right now under US rules, a standard qualifying mortgage, the safer type with legal protection, cannot have a term longer than 30 years. So to make 50 years mortgages mainstream, you'd have to 1. Change regulations, or 2. push people into non-qualified mortgages, which usually come with high interest rate and stricter terms. At this point, a reasonable question is, if it is that risky and that risky long term, who is this actually helping? Now, on the surface, the 50-year mortgage is sold like this. We care about working families. We want you to be finally able to afford a home. Here, have a lower monthly payment. But when you peel back the layers, there are some very clear winners. One is the big home builder who can now sell more expensive homes because buyers qualify for a slightly higher amount when payments are actually stretched. They can now advertise lower monthly payment with a giant asterisk, which is what the market is predicting to be. The other clear winner are the lenders. They collect more interest over decades because they market a so-called new innovative product that feels like a deal, when it is actually not. Now for regular buyers, the monthly payment just drops a little bit, the total cost skyrockets, the equity builds slowly and painfully, and the risk of being trapped into a bad position goes way up. So is this really a tool for affordability, or is it a tool to squeeze more out of buyers who are already desperate? And here's the part that really matters. Even if every bank tomorrow rolled out a 50-year mortgage, it would not fix the real problem, because the real problem is not that the mortgages are too short. The real problem is that there are not enough homes and the costs are outrunning income. You don't fix that by giving people longer payments. You fix it by making more homes affordable. My advice, be very, very careful with any product that processes affordability without addressing total cost and risk. Now, if this video helped you see through the hype, do me a favor. Hit the like button so that YouTube knows people want real information, not just hype. And subscribe if you want more information like this, which is fact-driven, no hype and no spills. And drop a comment below to tell me if you would take a 50-year mortgage. Why and why not? Remember, banks, builders, and politicians are always going to come up with new so-called solutions. Your job is to protect your future by understanding the math, not just the marketing. Thank you for the privilege of your time, my viewers. Thank you for watching, and see you in the next video.